Okay, so we're on part 4 now of chapter 15. I'm up to slide 60. So we have to start including the taxes that you personally are going to pay when we calculate the interest tax shield, because there's a dual problem here. There's taxes that the company pays, and they need a shield, and we have to include your personal taxes in the interest tax shield, right? And so basically, the amount of money an investor will pay for a security basically depends on the cash flows the investor will receive after all taxes have been paid. And you know the emphasis is on all taxes, including personal taxes, right? So your personal taxes reduce the cash flows to investors. So in my particular case, right, I have a lot of dividends I get every year, a couple $1,000s, and I get dividends on all my stocks, and I have to pay tax on them. So I got a big tax bill coming this year, and I usually have a big tax bill every year. So, that's the way that goes. But anyway, it's a consideration one has to have. It's a consideration. So the actual interest tax shield, and this is an important item, right? And this is pretty obvious. Depends on both the corporate and the personal taxes. So to look at the real benefit of leverage, you have to look at the combined effect, right? And that's the important thing here. Combined effect. We have to look at both the combined effect of both corporate and personal taxes, right? You got to look at both of them. So we got to start taking your personal taxes into account. So here's let's start up here on the tan area. This is a nice chart. So here's earnings before interest and taxes, like on a dollar, right? So if it's paid as interest, you get $1, right? And this is the pre-tax investor's cash flows. So the investor, I stands for the investor, right? So you have to pay tax on that $1. That's the tax from the investor, right? And basically, this is basically what's left after you pay that tax, right? To the debt holders. This is the debt side now, right? The pinkish is the debt side here, right? Okay, so you got that. So now let's look at the stock side. So here's dividends and capital gains. So the corporation has to pay taxes, T sub C. See that? Out that goes. That leaves you pre-tax with this amount, and then you get it, and that goes out. You have to pay taxes on the equity on a personal side. So this is what you're left with. Okay, this is exactly what you're left with. So this goes to the equity holders. So I hope everybody understands this chart. It's pretty straightforward. So anyway, here's a table that reflects the total federal taxes in the United States. Here's the corporate tax rate, and this was done under Trump, right? It was, you can see the drastic drop. It was lowered to 21%. So, and here's the personal tax rates on interest income, right? On debt, right? And here's the average rate on equity income, which is 20%, right? And I believe that's simply the dividends and the capital gains, right? So they give an explanation of what each is here. So interest income is taxed as ordinary income. You see that? Until 2003, dividends were also taxed on as ordinary income. So the average tax rate on equity income is an average of dividend and capital gain tax rates. All right. So you can clearly see how the tax rates have changed over the years. They've gone from the almost 50% in 71 to 78 in the corporate, and now it's down to 21. All right. So as you can see here, for every dollar received after taxes by debt holders from interest payments, right? This is on debt. Equity holders, basically it costs the equity holders 1 minus T, right, on an after-tax basis. So this came from what we saw in that previous table, right? So this is an important equation here, and this is an important statement. So basically, there's an effective tax advantage of having debt, right? And the effective tax advantage of debt, known as T star, is basically 1 minus the your tax rate on the debt, right? On the debt interest, right? Minus 1 minus the corporate tax rate, 1 minus the tax that the individual investor pays, all over the interest on the debt. If we go back for a minute and look what I, C, and E stand for, right? Here's interest, tax on interest income. Here's the corporate tax, and here's tax on the equity income, right, for the shareholders, right? So this is the effective advantage that bondholders have. So if we kind of look at that equation again here, which is rewritten. So when there's no personal taxes on debt income, so let's make TI equal 0. When the personal tax rates on debt and equity income are the same, the formula reduces to just the corporate rate, right? So if debt and equity are the same, this will reduce to T is equal to T corporate, right? So when equity income is taxed less heavily, TE is less than TI, right, on the debt, then T star is less than T equity, all right? So there's a couple rules with this equation. And if you throw some numbers in here, you could kind of figure out what's really going on here with this equation. So going back to slide 65, there was an error. There were errors in the wording of this slide, which I fixed. If you compare it to the book, you'll see it matches well. It was bugging me. So here's the equation, and this is the important statement. When there are no personal taxes on income, and this is what it should say, TI equal TE interest or equity equals 0, or when the personal tax rates on debt and equity income are the same, TI equal TE, the formula reduces to T star equal T equal, all right, equal just the corporate rate. And when equity income is taxed less heavily, TE is less than TI, then T star is less than TC. All right. So anyway, just wanted to make everybody aware of that. All right. I fixed it. You can see I got a note up here. I didn't like the way it was worded wrong. All right. So we're going to, here's an example from your book about calculating the effective tax advantage of debt in 1980 and in 1990. And here's the math as they take the data from the table, from table 15.3. And here was the tax advantage of debt in, it was 8.2, and for 1990 it was 34%. So the tax advantage of debt was much lower in was much lower in 80 than it was in 1990. So look at 1990, the tax advantage of having debt, which is why a lot of companies and a lot of like debt. Anyway, so that's that. All right, so here's another example, and given the following tax rates, what is the effective tax advantage of debt for each of the years listed? And I just want you to plug into the equation, right? So you just plug those numbers into the equation 3 times, and you can see in 1995 the tax advantage of debt was extremely high, right, compared to the other years. So here's the effect. Here's a graph which is a little cumbersome, but it shows the effective tax advantage of debt with and without personal taxes from 1971 to 2020 here. This is blue is without personal taxes, and this is the tax advantage at highest personal tax rate. So you can clearly see here. So the tax advantage without personal taxes for on just having a corporate was about 20%, right? So again, this graph shows the tax advantage at your highest personal tax rate, tax advantage of debt. Notice how over the years it has declined, okay, because of your personal tax rates here compared to what it was without personal taxes, okay? So I actually added a slide here. So figure 15.4 shows the variation in the effective tax advantage of debt since 1971 for investors in the highest tax bracket. It has varied widely over time with changes in the tax code, with 2018 marking a significant decline. So after adjusting for personal taxes, the tax advantage of debt has generally been below the corporate tax rate, but has also varied widely with changes in the tax code. Because not all investors pay the top tax rates, the true tax rate T star is between these lines. I don't know why they have a T here twice, but anyway. So you can clearly see how it's been below the corporate rate here, the advantage. It has gone down because of your tax rates. All right, so with personal taxes and permanent debt, the value of the firm with leverage. So here we have the value of the firm with leverage with permanent debt, okay? And we've seen this in different forms already. So here's the unlevered, here's the levered, and here's the tax with debt. All right, so this is the tax advantage, right, that we talked about. So if we go back just to review that real quickly. So here's the effective tax advantage with debt, and that's this T star. All right, so I just wanted everyone to remember that because we haven't seen that in a while. So with personal taxes, now this includes personal taxes, right, and permanent debt. The value of the firm's tax advantage with debt, with leverage, becomes this equation. All right, so personal taxes have a similar effect on the weighted average cost of capital. So here's the equation for the weighted average cost of capital here. Okay. For the company, right? Here's the corporate tax rate, and here's the cost of equity and the cost of debt. Okay, so basically, so there's a personal tax disadvantage for debt causes the weighted average cost of capital to decline more slowly with leverage, right, than it otherwise would. So if you have a personal tax advantage, in other words, you got to pay tax on debt, it's going to cause the weighted average cost of capital to decline more slowly with leverage than it otherwise would. All right. So I'll pick up here. We're about 17 minutes into this one now.